We're also getting back to a time period that I love of where the biggest hits of the year come out in the summer.
Typically, although,
movies.
Is there anything you're super excited about? I haven't seen anything I'm crazy excited about seeing.
The new Indiana Jones looks kind of fun. I mean, who doesn't love that from, our childhood and everything? And Harrison Ford, let's give him the salute out of there as Indiana, right?
Yeah.
But I'm thinking about getting you one of the Ken shirts from The Gap because, by the way, the new Barbie movie is coming out on July 21st. It's expected to be one of the big box office hits, and Mattel is doing its best to make sure that even if you don't go see the movie, you're going to stumble on more than 100 different types of Barbie buys in store and online.
Wow.
So I'm thinking about getting you a Ken T-shirt from The Gap because that exists.
Have you seen? I don't know. What does it look like?
It's just a plain T-shirt, but it's all pink and it just says Ken.
Oh, okay. It doesn't have like a picture of Ken on the front.
No. Or maybe
it doesn't say Ken across the front of it. I've got pink shirts, Kristen.
That's true.
Not like T-shirts, dress shirts. Pink's a great color.
What about
like a gray suit or something?
Hot pink Barbie electric toothbrush or a Barbie float for the pool? We got that?
I probably don't want to have my picture taken in the Barbie float in the pool, but I could see there might be one around. I probably have a child somewhere that wouldn't mind one of those. Yeah.
This just goes to show the marketing that is put into everything, because even at Bloomingdale's, there's going to be a life-size Barbie dream house installations available. And brands are hoping that nostalgia is going to win them over. And it might. Mm-hmm. I got to be honest. Look what I found in my parents' attic. This was just days ago, doing some cleaning. The Barbie Super Vet. Oh, hold on. Let me get the remote control here, Mike. Yeah, it all hooked up and ready to go.
That's worth some money, I imagine, Kristen. You've still got,
nostalgia. Let's get it. And
well, it looks like it's in fantastic shape.
This was a hand-me-down from my neighbor in the 70s.
Yeah.
And it's missing the windshield. I bet it still works if I put batteries in it.
Or it might catch fire.
Or I could brush Barbie's hair. That's looking kind of rough there. So anyway, we'll let that go back.
Was that Barbie? That looked like
it was a
Chewbacca.
Barbie?
That looked like Chewbacca.
Oh, man, so many things going on. I just thought we could use a little bit of levity because we just closed out a fairly strong first half of the year for Wall Street, from what I understand as a simpleton. And from what I've read as a simpleton, economic data is actually looking pretty good. Mm-hmm. Unemployment near historic lows, and consumer sentiment is rising. So, dare I say, Bidenomics could be working? I don't know. That's what they're saying.
Well, it's one thing. We don't have to go too far into that. Are the numbers pretty good when it comes to the economy? Yeah. Is Biden responsible? When you come out and you say, I created the most jobs in history, but it was right after the most jobs, right after COVID, the math just doesn't work, quite the same. But it's fine. I think, what we have to do is we have to apply what's going on in markets or the economy and apply it to the stock market and just ask ourselves, well, what is likely to be going on here, at least over the next quarter, if not for the rest of the year. The rest of the year is kind of a tough one. But with these numbers, I don't think that we're going to have a bad market here for the next few months. I think there's some volatility. It was probably not overly great, but also not overly bad. We've still got this recession looming, and I think most people that, certainly business and industry is looking at a slowdown. They're starting to reduce their inventories because obviously when there's a recession, people aren't buying as much. They don't want to have too much in inventory.
Right.
We're seeing layoffs. We're seeing all of these corporations prepare for what they think is going to be a pretty big pullback in the economy. But obviously, we're looking at how is that likely to affect markets, and then therefore the people that we manage money for. So currently, we're not overly pessimistic about the market. The numbers are pretty good. I think that inflation is not as low as it needs to be. It's not as low as the Fed has stated they want it to be. So it's even still right now historically high, even though it's coming down. But
And consumer sentiment is rising too, but it's still not where it used to be.
right, there's summer. I mean, you brought summer up in the beginning of the conversation, Kristen. It's kind of a feel good time for people, and that can be part of that sentiment lift. It's like, well, hey, I'm going to go on vacation with my family, or hey, I'm going to do this, or I'm going to go to the beach. Whatever it is, it's in theory, sunshine and happiness. So I'm not shocked that sentiment's a little bit better, but I think most people realize what's been going on isn't sustainable, and at some point, something's got to give. The market just can't. I mean. It just 2022. I know people think, 2022 was bad. It was bad. A 20 plus% drop.
That's what most people experienced in their portfolios. Yeah.
I mean, that's bad, but historically, that's not horrible, right?
Now, see, that doesn't settle well for the as an investor.
Nobody wants to lose 20 something
right.
It's just we haven't seen this, crash that people are sort of. They feel is looming because things are, the government keeps printing money, and seems like the market, we'll have a bad year like 2022, but now this year, at least for the first part of the year, I think things are going pretty well. So, with sentiment up, that certainly helps things. Inflation coming down, that certainly helps things. The jobs numbers certainly help things. But if you're retired or close to retirement, and you can get 4.5% to 5% on safe money in a money market account or something, how willing are you really going to be to take risk in this market? Do you think the market's going to be up more than 5% between now and the end of the year? Because if you don't, well, not the end of the year, between now or the next year, because if you don't, why wouldn't you just put your money in a fixed interest rate account where you're not taking any risk? And so the question when it comes to investing is, if I'm willing to take risk, am I going to be compensated for that? And somebody needs to measure for the investor what's the difference between those fixed rates that are safe and other investments that are out there, and just help them weigh the options. And it's back to your point with these numbers, what investments are available, which ones are likely to do well, which ones are likely to do poorly, and how much risk am I taking to invest in them?
Do you think that as Americans we will feel the impact of a recession before the end of the year, or do you think that we might come out unscathed as far as it not really changing our day-to-day lives?
Well, I think the best word that you used there was, do I think? Because it's really what nobody knows, right?
Right.
And so I think the summer's probably going to be pretty decent. So I don't think we need to be too pessimistic about markets, although I don't think there's a lot of room for upside in the market. What would the catalyst be for the market to be up 20%?
You tell me.
I can't think of one.
I feel like we're waiting on flying pigs at any moment, the way things have gone.
What could possibly happen in the economy to make the market go up a lot? I can't really think of anything, like I said. What could happen to make the market go down a lot? I can think of quite a few things. And then so when you balance that out and you say, well, how much risk do I want to be taking? And then what are my alternatives when it comes to investing? And I think, one of the issues that I see when I'm doing an analysis of a portfolio or just talking to them, an individual or a couple about their investments, it's usually not, the issue isn't whether or not they understand, at least to a pretty significant degree, how they're invested. The biggest issue that I see is when I look at the investments, I call it typical. So a lot of times it's very typical investments on stocks, bonds, mutual funds. That's, people know what they know. But if somebody didn't take the time to explain to them all of the options that are out there, then they're not going to know about them. But if they did, then their portfolio is likely to look a little bit different. So I personally can think of investment options that I think are worth the risk to get a higher average rate of return compared to just fixed interest rates at the bank. But I can tell you most people aren't aware of what those investments are, and they're certainly not annuities. Anybody that watches this knows,
Right.
We're not into annuities. But there are ways to have more control when it comes to your investments and have a more the outcome in some ways is predetermined. If you do this, then you get that. And I think that's a pretty interesting thing. And so that's why we promote just education when it comes to investing. Understand what all of your options are. When you understand all of your options, then you'll be able to make an informed decision.
So speaking of options, you being a fee-based advisor, a fiduciary, you're looking at stocks and all the things like you just mentioned. How big of a deal is it that Apple just became the first company to hit a stock market valuation of $3 trillion, I think? Yeah, 3 trillion shares.
All-time high.
Yeah, spiked 46% so far this year. So it looks like I've been really helping out, the Apple people a lot. It's like 4 things in here that are Apple. But what are your thoughts on that when it comes to our portfolios?
Well, I mean, it's... we've got a lot of our portfolios. Not all of them have, Apple is a component of those portfolios. It's been a great company to invest in over time. Apple has a great following. It's not always good, right? It's technology, so there's some volatility there. But I think Apple's just an example. There are other companies that would be examples, but it's a good example of a company that people believe in and they trust that, hey, listen, if I hold this long term, there's a lot of people out there that believe that it'll be worth more in the future than it is today. And you can't say that about all companies. And so that's part of the reason why they're now, $3 trillion. That's a huge number. Will they still be at that valuation next year? I don't know. But what will their valuation be 10 years from now? Right? That's kind of a more interesting thing because there's going to be volatility there. So, but then I think about Apple being at $3 trillion, and I know what the price of their products are, and I start to ask myself, where are all these people getting this money?
That's
I'm
where
more
I was
worried
going.
about that.
That's where I was going. We're hearing about layoffs and consumer sentiment is getting better, yet I feel weird about things. People I talk to in regular day-to-day life aren't comfortable with a big purchase right now or a big risk. So how is everybody spending so much money, I'm included, on the latest iPhone?
Yeah, where's the money coming from? Because, we all know we've printed a ton of it, and the government, at least at this point, doesn't have a plan to pay it back.
True.
And eventually, you can't print money out of thin air, although people seem to be getting pretty comfortable with this idea that you can, because I just don't think, when we talked about the economic numbers before, that things are pretty good, something that I'd be very interested in seeing is what is the savings rate for Americans?
Oh, I'm going to look that up.
Are they saving any money, or are they and what we're seeing is they're actually borrowing money. So the credit card debt's going up. So that's an issue. So you can see the economy just humming right along, and then you try to define where the money's coming from. And if they're borrowing more and saving less, again, that eventually becomes a problem.
So we can't be Forrest Gump and just send our money off to Lieutenant Dan and think it's invested in some fruit company and find out it's Apple Technologies and I got it. Okay. Yeah. So congratulations, Apple. And I'm a proud supporter, but, and I have a little piece of stock here and there I play with, that's one I'm partial to with that play money. But it sounds like overall, it's hard to know what to expect for the rest of the year, but you are planning in a protective way for the portfolios that you manage for the clients of Talon Wealth.
Yeah, I think the way to look at it would be what's the most efficient way to get a particular return. So right now, if your goal is to make 4.5% on your money, and that's your goal, your most efficient way is probably treasuries, because you're not, the risk is very low there, or a money market account. The risk is very low there, and you can get that. That's all you really need. If you turn around and your goal is 6% on your money, well, now how do we have to tweak this a little bit? Because you're going to have to take some kind of risk to get there, but how much? Or 8%. What if you're looking for 8%? So the efficiency just comes in how the portfolios are built or how the investment is built. If I went to someone and I said, I've got these 2 investments. Okay. Both of them are averaging 8% per year. Which one would you like to invest in? Most of us are conditioned to feel like, well, if they're both averaging 8% per year,
split the difference.
Put half my money in one, half my money in the other. I don't want all my eggs in one basket. I want to be diversified and all of that. But through analysis, we can find out out of those two investments, how much risk am I taking to get the 8%, right? Assuming these aren't fixed rates, of 8. So if I change the question a little bit and I said, well, I've got two investments, both of them are averaging 8% per year. One of them's half as risky as the other one. How would you like to invest your money? So that's why we talk about making informed decisions. It's a very different answer. Somebody would look at me like, well, why would I take twice the risk to get the same return?
Right.
Right. It's very practical, and that's how they should feel. So that's how we want to make sure that when it comes to returns, I know we can have a goal for the return that we're looking for, but then how much risk are we taking to get that return, and how do we create the most efficient portfolio?
And for that, we will talk more about it next week. But we also invite you watching to go to guardingyournestegg.com, catch up on previous video podcast, our audio podcast, and you can even find the office closest to you and even schedule a 15-minute phone call, all from our website, guardingyournestegg.com. Mike, enjoy the rest of your week, my friend.
You too. Thank you.
Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.